Hey guys, it's Sebastian from AskSebby, and today we are going to look at 5 different tactics that you might want to consider if you are someone that's currently invested in the market or you're considering investing in the markets. Before we dive into it though, a big favor is to give this a thumbs up. It doesn't cost you anything at all, and it's probably the easiest way to support the channel. So we'll talk about 5 different tactics, and then towards the middle and end of the video, I'll talk about my current thesis and what I'm doing. I'm not going to talk about specific instruments or investments purchases I'm making for that part of it, but just my general thought process. One quick disclaimer that I give for all of these type of investment videos is that you need to do your own due diligence. This is not investment advice and this is not financial advice. I'm not a financial advisor, I'm not your financial advisor, so make sure that you are doing things that actually make sense for yourself. With that said, instead of diving into number 1, we're actually going to dive into number 0, and that is having enough runway and having enough of a rainy day fund. So we can talk about investment stuff all we want, but if you don't have that liquidity to put food on the table to pay your rent, then that's going to be a big problem. I typically recommend 3 to 6 months just because for me that makes sense. Some people are happy with 1 month. It really depends on you and your risk tolerance and whether you're someone who lives at home or you have the ability to live at home. For a lot of people, I typically actually go up to 12 months, but I'm also a bit crazy. This is going to be especially true if you are someone that works in specific industries. Events is going to be a very obvious one just because there's so many cancellations. So South by Southwest is a good example of this. And if you're someone who works in catering, if you work in anything related to that space, then you might be financially impacted and you just want to make sure that you're going to be safe. Airlines is going to be another one, especially if they recommend that you start taking unpaid vacations just to keep costs down. I'm not going to stick on this one for too long, but I just think that people need to be careful. Diving into number 1 though, we have doing nothing at all. And this feels like a bit of a cop-out, but I think it makes sense to take a step back and make sure that you're actually making a rational decision. The last thing you want to do is to panic sell just because the stock market's going down, or to panic buy, so FOMO buy, just because you see things are going up, and you just want to make sure that you're in the right mindsets. Take a step back and make sure that you're going into this with a strategy. It might not work out, it might be completely wrong, but at least you're not trading or investing off of emotions, you're doing it based off a plan. Tactic number 2 is treating this as a buying opportunity, and this is definitely what a lot of other YouTubers are doing. I believe Graham is doing this as well as Meet Kevin, and a lot of other people I know in tech are also doing this because they see that dip and they feel like it's going to go back up, and I think that's perfectly reasonable, especially if you are a dividend investor and you're someone who's not looking to sell in the long term anyways, then this is a good time to buy. I'm not telling you to buy, I'm just saying that this might be a good time given that thesis. The big question though is what happens if it drops in another week or if it drops in another month and you can get it for a cheaper price. A funny example of this is actually going to be Barney's going out of business. So they had that bankruptcy and you could get stuff off for 20% off, then it dropped to 30, 40, 50, and then I think eventually something like 90% off. So you do want to make sure that you are in a position to buy when that happens. I'm not saying to time the market because I don't think that necessarily works. I'm saying that you want to DCA, so this is going to be dollar cost average. So you want to buy it based off a period that you feel like makes sense. So let's say you want to invest $10,000 into a specific sector or a specific stock. Instead of doing that all today, maybe doing 1,000 today, 1,000 next week, 1,000 the week after, or you can break it up, maybe 100 and something today. You get the idea that you want to DCA it. That way you lower the risk of you feeling bad if it actually does tank. The advantage if it tanks is that you're buying it at a subsequent lower price. So let's say it's here right now and then it drops down here. The advantage is that you would end up buying it at an average of that middle points of the purchases. And then if it goes up, then it ends up being a bit more expensive. But I just feel like when you DCA, you end up taking the emotion out of it, which is what I think a lot of people need to do. End of the day though, you can obviously do whatever you want and whatever you feel like makes the most sense. Full disclosure, this is what Mandy's currently doing, and I think as long as you have a long enough time scale, so if you're looking 20, 30, 40 years out, then that is going to be fine. If you are someone looking to try out a new platform, or if you are new to investing and you want to get your feet wet, we do have a bunch of referral links down below for things like Robinhood, Public, as well as Webull. My recommendation is that you try out a few of them just because most of them don't have a cost, and it really does depend on which one you like. It's kind of like a car or a phone. iPhones work, Android phones work. It just depends on what you like and what you don't like. Links down below really does support the channel if you use them, but let's dive back into it. So number 3 is going to be a bit different, and I think people might get angry about this, but this is going to be taking money off the table. It's not about timing the market, it's about time in the markets. I definitely get that, and I think with a long enough time scale, that is fine. That's a very good thesis. But if you are someone who needs that money, let's say you're someone who's retired, let's say you're older than 65 and you're looking to use that money in the next 5 to 10 years, just because I'm assuming that you save this money for this period of time to enjoy it, then that makes sense. If you're someone like Beat the Bush and you make most of your money from YouTube as well as from your investments, it might make sense to take profits off the table and to de-risk. We've had a very good run up, and I think a lot of people are just afraid of taking profits off the table when they are doing well. As long as it's an educated one and as long as they're not panic selling, then I think it's fine. Something that you might have noticed is that I'm not telling you what to do. I'm just trying to lay out all the options for you, and you need to make your own decision. Number 4 is going to be a lot more confusing, especially for people who are new to investing or who don't really know about options. And this is going to be locking in your profits. So let's say you're someone who has a very big portfolio, you see this drop and you just want to lock in your gains, but you don't want to sell due to tax consequences, due to how capital gains work if you haven't held it for at least a year, then it might make sense to buy some put options for the different stocks that you have. So for example, if you hold 100 shares of Disney and you're worried about this drop, then maybe it makes sense to buy one put option, given that a put option represents 100 shares. If you're someone looking to speculate, then maybe it's something out of the money, but if you do want to just de-risk and you want to lock in your positions, then something in the money should do pretty well. Dave Hansen did a pretty good video on this about pausing the stock market after he had a $500,000 loss. So this is going to be a bit more complicated, especially if you've never studied options before or a lot of these other things before. And I think he does a lot better of a job explaining this. Too long didn't watch. It's the same idea as buying car insurance or buying insurance. If something bad does not happen, then you spent money on that insurance, but you just lost it. And then if something bad happens, you're protected. One thing to be careful with here is that you don't want to do too much. So if you don't have a big portfolio, if you don't have a lot of holdings of Disney, then it doesn't make sense to buy one put for Disney because that is more exposure than what you currently have. In that situation, it might make sense to buy a put on something like the SPY or maybe something like an inverse ETF. For people who don't want to worry about options, who don't know what the heck I'm talking about, I think an inverse ETF is going to be the way to go. For people who want to play it a bit tricky, you could also sell some covered call options. So if you do have these large positions, but you don't necessarily want to lock it in with put options, it might make sense to just sell calls and you're covered. The risk is relatively low since you already have it. Please don't sell naked call options because that's asking for trouble. Tactic number 5, and this is what I'm doing and also something that I don't recommend for most people. Tactic number 5 is betting on volatility. So I'm not sure if the market's going up or down. I feel like it's going to go somewhere though, given how crazy things have been. People I know have been buying put options and call options, and these are considered either strangles or straddles. So imagine you're buying this side as well as this side. If it stays within this range, then you end up losing a ton of money. You basically lose your whole investment for those specific options that you have. But if it goes this way, or if it goes this way, and it doesn't matter if it's up or down, then you are actually going to make money.
Down 7.5%, tech down 6.3%, communication services down 6.2%. There is nowhere to hide. Up top, those sectors that are outperforming with.
So I have a bunch of those positions, and then once the implied volatility got a bit too high, so the IV made it a bit too expensive, I have a bunch of investments that are related to the VIX. I wouldn't be surprised if the VIX hits maybe even 70, so we'll see what happens. Not financial or investment advice. The main takeaway is that if you're someone who's panicking, don't panic, just step away, don't do anything crazy. If you're someone who sees this as a buying opportunity, I think that's very fine. If you're someone who wants to protect himself, there's a bunch of ways to do that. If you're someone that needs to sell, do that as well. And then there's a bunch of other ways to speculate. On one hand, this video didn't tell you what to do, so I think if you were here for that, you're going to be very disappointed. But I think for a lot of other people, they just want to see different options that they have and different strategies that they can take. Similar to credit cards and pretty much everything else that we do on this channel, your mileage is going to vary. Do what makes sense for you. My question for you guys is, what are you currently doing? So are you loading up on some shares? Are you de-risking? Are you doing some option plays? Let me and the community know in the comments down below. If you liked the video, give it a thumbs up. It really helps us out. If you know anyone else who'd benefit from what we just talked about, share this with them. It'll probably help them out. But otherwise, hope you guys liked it. See you guys next time.